must be hard to actually operate in this kind of environment where treasury yields are now at 5% for the 10-year. When you look at the cost of money, the cost of credit going up, and things could get much more difficult.
Well, Francine, first, thanks for having us here, in Riyadh, and it's a great topic because I think a year ago, when all this started, I think we said that now, liquidity at a cost and money has some value. And effectively, to your point, and these were, the opening statements of His Excellency Yasir Al-Rumayyan, Governor of PIF this morning, which was the core focus on his opening remark. Is higher for longer, this 5% that we hit, yesterday. And as an investor, as an asset manager, as a, risk underwriter, I think it's actually more healthy to be in this environment because now we can effectively underwrite, asset price and I would say more, asset value with the appropriate assumptions.
And there seems to be shock after shock after shock. And the latest, of course, is geopolitics.
Yes.
It's very difficult to know how it ends up and whether the conflict escalates. But is it going to be bad for business? Is it going to be, even if it doesn't escalate, will people not want to spend? Consumers, business, and inflation therefore going higher?
Yeah, Francine, I think, we are in the risk management, risk underwriting business. And at any point in time, we have to factor in these externalities. And as tragic they can be, over the past, few weeks, that's another externality that we have to factor in. So great opportunity to invest because now effectively you've got some return associated with this investment. You are fighting with the risk-free rate because today's effectively investors, they can park their cash at 5%. So whenever you want to convince them that the opportunity is there, then the premium has to get, to the level they need.
But Mathieu, if you look at rates in general, and actually, again, the cost of money, what will it break next, and what does it mean for where you want to be investing?
Okay, so we're back to an environment where you can compound your investments. 5% risk-free rate, 5%, risk premium, and all of a sudden you start investing in credit at a high single, low teens, return, and you can compound that. As a lender, what President Banga, was saying earlier, President of the World Bank, they need private capital. They need private capital because the public money in itself, won't be able to face the challenge and the opportunity of all those mega trends that we need to invest in. Decarbonization, cybersecurity, regenerative agriculture. He was talking about, how we grow rice today. And so there is effectively a huge opportunity for this private capital in a healthier, quote unquote, investing environment because now you can effectively appropriately assess your return. And that's where I see the opportunity.
But where do you see opportunity? So is it harder to find things because there's a lot of capital chasing the same assets? Or actually, because there's going to be a correction, you're in a good place?
No, I think, Francine, the world remains a very wide place. I mean, you can, see that again, today. So this whole theme about too much money chasing too little opportunities, I think it's somehow a little bit biased because once you get very local in some, economies, countries, jurisdiction where you can deploy, your capital, then you make the difference. If you're sitting tight, in London, waiting for the opportunity to come to you, or New York, or Singapore, or Dubai, it's a very different story than having this footprint and being able to talk to entrepreneurs, to CEOs, to executives, like we are doing today at FII. And here you create great opportunities.
And I know you're, for example, interested in the transition, the green transition. But if you look at commercial real estate, which is probably the next shoe to drop, what does that mean for other asset classes?
Yeah, well, I think they picked up earlier on, and Steve Schwartzman, himself was saying that 20% of commercial real estate in the U.S., is vacant, today. But that in itself is once again an opportunity. I get back to, basics, corporate finance 1.0, supply, demand. And whenever, the supply is higher than the demand, this is where, as an investor, you can make good entry level. So commercial real estate, in itself, is it going to zero? No, it's not going to zero. It's about, asset selecting. It's about, where you effectively deploy in terms of geographies, in terms of assets. And I really believe that you can once again create some high single-digit cap rate for commercial real estate, but warehouses is another one, residential, leisure and traveling hotel, is another great play.
But are you not surprised that with interest rates, going higher in such a fast space of time, that there's not more muddle, that there's not more breakage, especially in shadow banking?
Yeah, well, that's again, on the financing side, this is probably where we have to focus most. I mean, we at Tikehau, we've been also entering this market where we can provide some financing, much more conservative, 40, 50% LTV, loan to value to an asset, to a real estate asset. At times maybe higher, but you get, 8, 10, 12, 14% return. That on a risk-adjusted basis. If you've got this patient capital, once again, you can compound, and then you make 2x, if not more, on your capital. And in this environment of such high volatility, this is what investors are looking for.